The content provided on this channel is for educational and informational purposes only and should not be considered as professional, financial or accounting advice. इस चैनल पर फराहम करदा मवाद सिर्फ तालीमी और मालूमाती मकासद के लिए है और इससे पेशावराना मालियाती या अकाउंटिंग मशवरे के तौर पर नहीं समझा जाना चाहिए। In today's lecture, we will learn about cash equivalents. The lecture is presented in English language. In this lecture, we will learn definition of cash equivalents, characteristics of cash equivalents, and importance of cash equivalents. Definition of cash equivalents. Cash equivalents are highly liquid investments that are easily convertible into a known amount of cash. Cash equivalents are subject to an insignificant risk of changes in value. If these two conditions met, it will be the cash equivalents. Why are cash equivalents being current assets? Because it's resource controlled by an entity due to past event, and in future it's expected that economic benefit will flow to the entity. For example, government bonds, term deposit receipts. Characteristics of cash equivalents. Short-term maturity, low risk, high liquidity, and its purpose. Short-term maturity typically have a maturity period of 3 months or less from the date of acquisition. They carry minimal credit risk and are subject to negligible changes in value. Often held by companies for meeting short-term obligations. And high liquidity can be quickly converted to cash without significant loss in value. These are the characteristics of cash equivalents. The next question is, why are cash equivalents important? Cash equivalents are important for liquidity management, financial health, and investment strategy. Liquidity management shows a company's ability to meet short-term obligations. Financial health provides a clear picture of available funds. And investment strategy indicates how a company manages idle cash to earn returns. Thanks for watching. For any question related to topic, please comment. Subscribe my channel for more videos.